Good morning, students. We can start the class. So I hope you are safe. During the pandemic, we can't expect more than that. The safety is the first. So I expect that you are safe even though the pandemic is, or Sri Lanka is getting severely affected by the pandemic, and every day there are more than 900 people get affected. So I hope you are safe, and with that expectation, I am starting the class. This is a usual announcement. If you will have any questions or any comments, you can send it to me through the inbox. So once I see that comments or questions, then I can able to answer to you all. That is our usual arrangement. So in the last class, you would have remember that the last class we have started the financial reporting and analysis section, which is also I have, as I mentioned the last class, this is again 20 marks questions area. So if you all have studied this area, the financial reporting and analysis, and then subsequently there's another area called audit. So by mixing those two areas, there will be a question for 20 marks. That is the general pattern in the past paper. And as you'll remember, we have stopped the class at the middle of the presentation because due to the time constraint. So just to have an idea, we have we have discussed about the financial reporting and why financial reporting is important, and who are the people expect or need the financial information, and why they need those financial information, and the financial reporting process we have studied in the last class. Then we have studied about some legal and regulatory requirement on the financial reporting, and what are the act related to this financial reporting, especially for the financial institution like banks and finance companies and insurance companies, etc. Then we have studied about some in the accounting standard which is applicable for preparation of financial reporting, and then some the legal aspect related to the publishing the financial account statements with related to the banks and non-bank and audit institutions. After that, we have discussed something about the major disclosures in the financial statements, and then first we have discussed about the why disclosures important, and then we have discuss about the applicable laws and regulation in detailed manner, and then we have discussed about the primary financial statement disclosures. And actually in the financial statement there are 5 components, as I mentioned last class: the financial balance sheet position, and profit and loss accounts, and statement of changes in equity, and cash flow statement, as well as accounting policies and notes to financial statement. So these are the general 5 components, but generally there are 3 main components, which is balance sheet and P&L, cash flow statement. But if you see the primary financial statement, you have to mention these 5: the balance sheet, P&L, equity, changes in equities, and cash flow statement, notes to the financial statement. Even in the income statement, the profit and loss account, there are two components: the profit and loss for the period, and other comprehensive income for the period, which is actually under this SLFRS 9 and all. We had to the companies has to prepare and publish it. And then we have very in a lengthy manner we have discussed about the risk management disclosures and each and every component of the risk management disclosures. Then I have stopped the class at this point where the related party disclosures is required for the financial statement. Actually, in the related party aspect, we have studied in the risk management as well. So here what we have, and we will discuss something more in the corporate governance as well in the following classes. So here those related party aspect has to be disclosed in the financial statements. So the related party and its relationship, why they are required to disclose the related party things to the financial statement is because normally there may be, or to ensure that there is a arm's length transaction between the company and related party. Because generally with the related party there may be favorable transactions, because the related parties may try to get some favoration from the financial institution, which will affect the other stakeholders in the bank or financial institution. So having that, so the related party transaction should be disclosed in the financial statement, which will be the separate disclosure requirement in the financial statement. Normally the notes to financial statement, that section include the related party. So where they have to mention nature of the related party relationship. So the related party can be created. I think we have already discussed related party relationship can be created through various channel. Various channel in the sense, if a company director, if any exposure granted to company director, the company director will become the, or any company directors will become the related party, or spouse of the company director. And if there is a major shareholder of the company director, and if there is any spouse or children below, particularly the spouse of the key management personnel. Key management personnel, of course, we have discussed already, which is CEOs, DGM level, AGM, CRO, the Chief Risk Officer, Chief Compliance Officer, Chief Internal Auditors. Those type of positions are called key management personnel. So the spouse of the key management personnel also can be considered as a related party. So there may be several relationship in the related party can be created through several relationship between the outsiders and the company. So we have in the disclosure, we have to mention nature of related party relationship and information about the transaction. Again, the transaction can be several transactions. It may be, if it is a bank, for example, if we take as a bank, there may be deposits, or there may be the loan granted to related party, or we can accept the deposit from the related party, or sometimes some services can be provided to the related party, or we can procure some services from the related party. So we have to mention those things in the financial statement, but the information about the transaction. Then third thing, we have to mention about the information about the outstanding balance. For example, generally in the banks and finance companies, when we are going to for the examination, this is one of the main area we are checking, the related party transaction. So there may be limits, but some related party people, they may not use that limit, but some they may use that limit. So in that what is the outstanding balance? For example, if they granted the loans, they may granted the 100 million or 50 million rupees, but at the time of examination of the financial statement date, the outstanding may be 30 million or 35 million. So they have to disclose that information. What is the outstanding balances? And information about the impairment or bad debts with related to the related parties. So here sometimes it is the most related concern. Sometimes the related party may not honor their obligations. It means they may not repay the loans which obtained from the banks and finance companies, and that particular loans may categorized as a bad loans. So in that case, we have to, the bank, particular bank and finance institutions has to disclose about the information about the impairment of bad debt with related to related party. These should be disclosed for each category of the related party, example parents, subsidiary company, associate company, joint ventures, key directors and key management personnel, major shareholders, other related parties, which I have already explained to you. So with related to the all related party transaction, they have to disclose. And here, of course, they say that disclose of the key management personnel. That is also they have to disclose as a part of the related party disclosure, short-term employee benefits and post-employment benefit, other long-term benefits, terminal benefits, share-based benefits. Because in some companies, not in Sri Lanka also we can observe, but in the foreign countries, of course, the CEOs and some key management personnel are getting more benefits from the banks and finance institution. They have profit and more the profit, their salary may be very minimal, but their bonuses may link to the profit. So those type of things has to be disclosed. So short-term employee benefit, post-employee benefit in the after retirement, other long-term benefits and terminal benefits, everything has to be disclosed under the related party. So these are the disclosure requirement is necessary with related to the related party in the financial statement. Do you have any questions related to this? Otherwise, I can just move to the other areas. Okay, then there's other area, the corporate governance disclosure. So in the financial statement, they are making the several disclosure. If you take some financial statement of or annual report of the bigger banks, for example, DOC, you can see all these disclosures in the annual reports. So because annual reports having quantitative plus qualitative information. So under this, the quantitative information, of course, as we discussed last class, the financial statements, normally generally P&L, profit and loss account, cash flow statement, changes in equities and all. But qualitative, this risk management disclosure, related party disclosure, likewise, they have to mention this type of information. So part of the disclosure, the corporate governance disclosure is most important thing. And where they have to mention about the chairman, CEO, board composition, profile, experience, qualification, etc. Why they have to disclose this information? Because if it is a potential investor or outsiders, any stakeholders, they wanted to know the competence level of the management, then they should know who is the chairman, CEO and board composition, their experience and all. That is the purpose. They have to disclose the board, this board of directors composition and their information. And then again, they have to, in the financial statement, they have to mention about the board appointed committees. So there may be several committees appointed as the board subcommittees, or board appoint several committees, where we have already seen the board risk oversight committee, the audit committees and remuneration committees, and there are management, the risk management committee. There are several committees appointed by the board. So those committee information has to be mentioned in the annual report. For example, objective of the committee and composition. So how many board members are representing those committees, and how many senior management, key management personnel are reporting that are in the committees. Those type of information, composition, structure, function, attendance of the different committees such as audit, nomination committee, remuneration committee, risk management committees. They have to disclose. You can ask the question, why these informations are disclosed in the annual reports? Because one is to show the greater transparency. Because in the companies, in the financial institutions, particularly in the companies, the management personnel are different from the owners. So in that scenario, the management people has to create a transparency then only the stakeholders, particularly the owners, will get to know that, okay, these are the functions are taking place in the company. For example, if it is a board appointed committee, when they are when they are disclosing the composition and structure of the committee, we can take an example of the audit committee, board audit subcommittee. Then in the best requirement code of conduct saying that the corporate governance code of conduct saying that the audit committee should be represented by non-executive directors. Particularly the independent directors are most welcome. So then in this scenario, when they disclose this composition, they can check whether these audit committees are represented by the non-executive directors or independent directors. So those type of information the stakeholders can get it from the this type of disclosure. Then they have to disclose about the transaction with related party. Of course, we have seen this in a detailed manner because under the corporate governance also there's a requirement of disclosing the related party transaction. The key performance indicators. Key performance indicators in the sense capital adequacy ratio and other key ratios, growth, trends, and reason. So they have to key performance in the KPIs. They have to disclose, and various disclosures under the different reports, directors, management, corporate governance, internal audit, and risk management committee reports also disclose under the in the annual report. Actually, you can get more flavor when you go through one of the annual report, especially the big bang annual report, the largest bang annual reports. Then you can get some ideas. Some annual reports are really written well. Whether they are following or not, they are written in a well manner. So these are the disclosure related to the corporate governance, and then they are making some disclosure related to the fair value disclosures. Fair value disclosures, of course, those who are involved in the accounting, they may know that under the earlier this now it is SLFRS 9. Under that, they have to disclose the fair value transaction details in the their financial statements. Under that, there are several type of disclosure. First one is the cost-based disclosure. The cost-based disclosure. First, we can start from the bottom of the pyramid. If we start from the level 1, which is the fair value, the quoted price for similar instruments. So that is they have to say whether they have followed which valuation method for their assets in particular category of the assets. So the one of the category is the quoted price for similar instrument. It means they can just they can mark to market. And then second one is directly observable market inputs other than level 1 inputs. So if there is a similar, if there is no similar inputs, there is another way. They can just directly observe the market inputs other than the level 1 inputs. So they can just this is another way of calculating the fair value. So this is level 2, and in the level 3, inputs are not observable market data, and based on the best available data that can be formed internally and externally. Actually, these are most accounting treatment. For example, if I invest in the JK shares or commercial bank shares, then in the fair value there is no issue, because every day the similar stocks will be traded at the stock market. So end of the period or every day I can just revalue fair value, make the fair value of my investment in the particular share. But the other thing is there won't be any particular shares, the particular assets are not available, but we can get some observable market inputs. For example, if I invest in the government securities market, sometimes particular series may not get traded because government securities market are very illiquid market. The transactions are very minimum. So in that case, some days there may not be trading available in the particular series of the stock, the series of the bond. So what they can do is they can just observe the similar stocks and they can do the fair value based on that. And the level 3, of course, there will not be similar stock value or the same stock value, but there may be some acceptable informations. Based on that, they can make the valuation. That is sort of level 3. And the final one is cost base. Because in some certain circumstances, they may not do the fair value, but they will follow the cost base method. For example, if they invest in the subsidiaries and they will keep that investment for a long without maturity date, then of course they can treat that in the cost basis because it's a subsidiary, strategic investments. So likewise, they have to mention what is the fair value methodology and valuation techniques and all has to be disclosed in the annual report. This is also one of the disclosure. Actually, it is better to have an idea what are the disclosure requirements or what are the disclosures are available in the annual report. Sometimes you may answer based on these informations. Another thing is if it is a the bank, then they have to do the Basel III requirements. The Basel, you know that the Basel, there's a Basel Accord, the Basel I, Basel II, Basel III we have implemented. Now we are implementing the Basel III, and under the Basel III there's a pillar 1, pillar 2, pillar 3. So based on the pillar 3, this is a market discipline, the market disclosures. So under the pillar 3, they have to make some disclosure requirement, so which is applicable from the 1st July 2017 onwards. The objective is strengthen the stability of the financial system by allowing the market participant to assess key information on the bank's capital risk and control process. So under the pillar 3 of the Basel 3, they have to make because to give some more information to the market about the bank's capital risk and control process, they have to make the disclosure. And the second objective is improve the consistency and comparability of the information across the banking institutions. That is generally the disclosure requirement. The last class we have discussed this in detailed manner. So how can they, because even any financial statement, there should be a comparability. The comparability should be on consistency. Because consistency in the sense, the banks or financial institution has to follow a consistent method to throughout the period to report the particular thing. There should be a consistency and comparability. Comparability in the sense, the bank X financial statements should be compared with the bank's Y financial statements. So there should be a common format. So this improve the consistency and comparability of the information across the banking institution. There's a pillar 3 requirement is necessary. And other objective is facilitate assessment of the bank by others, including investors, analysis, customers, other banks and rating agencies, which lead to good corporate governance and transparency and market discipline. So these are the some objective of the pillar 3 disclosures. And disclosures on capital and liquidity, risk-weighted assets, capital planning, regulatory and accounting reporting and risk management, they have to make the disclosure. Under this, of course, what they are doing is they may have the capital, they may have the liquidity right now, which may be above the stipulated level, but after some time, after in the future or after 1 year, or after 2 years, the bank will get expanded. Their business will get expanded. The bank may open more branches. Bank may capture more. Bank may have more relationship with the customers and grant more loans and advances to the customers as an expansion of the business. At that time, this risk-weighted capital and liquidity may not be enough. So in that case, they have to have the disclosure, okay, this is our idea for a next period and this will be the capital and liquidity, and we are expected to expand the business this much. So based on that, our capital level we will raise, or through the retained earnings and all, we will cover that additional capital requirement. Those things has to be disclosure in the pillar 3. And the final one, there are 14 templates and quarterly and annual basis in the press in the website, both on solo and consolidated basis. So there are some templates they have to make that disclosure. Okay, before going to the financial performance analysis, you will have any questions on these areas? If you have any questions, I can just make an answer. Okay, then I'll move into the next area of this today's class, financial performance analysis, which may be helpful to you all to answer the questions in the paper as well as for the general knowledge. In the financial statement analysis, financial performance analysis is one of the most important analysis you have to follow. So the financial information analysis, there are 4 components. As I mentioned, in the financial statement, there are 5 performance. One is notes to accounts. Other than the notes to accounts, there are 4 components of the financial performance. One is financial position. Financial position means the balance sheet. As a particular date, what is the financial position of the company or banks or financial institutions? The financial position, of course, this is sort of stock variable. At a particular day, this is the capital they are having, this much of loans and advances they are having, this much of deposit the particular bank is having. Likewise, this is at a particular date. At a particular date, there's a position, financial position. The second one is financial performance, which is to calculate for a during the period. Most relevantly, this is related to the P&L, profit and loss account of the financial statement. So first we will do some analysis based on the financial position. It means a balance sheet. Second, then we will do some analysis based on the financial performance. It means profit, the performance for a during the period. It may be profit and loss account or any other things. This for the performance of the company or bank for a particular year. And third one is cash flow statement. Of course, everybody knows about the cash flow, which is a separate statement which will give some idea about the cash flow statement. Sometimes some banks and some companies, they may well perform, they may more profitable and everything, but the cash flow may be a problem for that company. So cash flow statement has to be the analyzed. So some analyses are based on the cash flow statement. Finally some analysis are based on the equity of the company. So financial performance analysis are based on the 4 things. First one is the financial position. The second one is financial performance. The third one is cash flow statement. some are based on the equity. So the techniques for the financial performance analysis, we are using several techniques. The one of the technique is ratio analysis. The ratio analysis, we will see that some ratio analysis later on. The ratio analysis generally giving the idea, okay, what is the ratio? For example, NPL ratio, or sometimes ROE ratio, return on assets, ROE, return on equity, profit ratio, gross profit ratio. Likewise, there are ratio analysis. So this is one of the technique they are using for a financial performance analysis. And the second one is trend analysis. Trend analysis in the sense, over a period of time, they can see what is the trend is going on. Simply, we can say that profit growth. Okay, we can take the profit growth or asset growth. Okay, what is the trend analysis will show asset growth for over a period of time. For example, in 2015, asset growth may be 10%. 2016 asset growth may be 9%. But 2018 asset growth may be 11%. Then 2019, likewise, there may be different asset growth. So based on these points, by connecting these points, we can do the trend analysis. So trend analysis will show that whether the banks and finance companies are expanding or performing well, or they are struggling over a period of time. So basically, you can understand that the ratio analysis will give some idea at the point of time, but trend analysis will give an idea for throughout the period. And then some comparison with the strategies, target, peers, and industries also calculated in the financial performance analysis of the one of the techniques. All these techniques are related to the accounting techniques. And the second technique is statistical techniques. Statistical techniques are more statistical manner, and with a statistical package and all, they will have some statistical techniques. Actually, today's class we are going to discuss something about these accounting techniques. We will not discuss about the statistical techniques, but it is better to know, have an idea that okay, there are statistical techniques as well. Okay, so financial performance analysis, based on these 4 components of the financial statement, we can do the we can follow the 2 main techniques, accounting technique and statistical techniques. Then we are just saying about the objective of the performance analysis. Okay, we have discussed about the financial performance. We say that we are going to do some accounting technique based analysis, and we are going to do some statistical technical analysis. We will do it. Okay, what is the objective of the performance analysis? Because there should be some objective now. So the first objective is to strategic planning, decide on expansion and new product, etc. Because the strategic plan meeting or of a strategic plan process, every bank and financial institution will decide, okay, we will go for a expansion, or we will maintain our business as it is, or we will reduce our business level in the future period. Generally, the strategic plan, which is prepared for 3 to 5 years period, they have to decide their future strategies. So in order to decide the future strategies and strategic plan, they should have the performance analysis. They have to do the performance analysis. For example, the bank, for example, bank A, let's assume bank A. The bank A having lots of issues on generating profits. their operating expenses are very high, which operative expenses are not enough to meet or are not enough for the to make enough profit. In this scenario, can that particular bank go for a business branch expansion? Can or not? Are you understanding the scenario? Scenario is a bank X, which is having the high operating expenses, and they are due to the high operating expenses, they could not produce adequate profit. Sometimes it's a marginal losses also incurring in certain quarters due to high operating expenses. In this scenario, the performance analysis showing that this scenario. So under this scenario, can that particular bank go for a branch expansion? Can or not? Cannot. Exactly. Because they are having higher the operating expenses. So if they are having the higher operating expenses, if they go for a branch opening, that will increase the increase their operating expenses further. So the strategic plan, they can't decide to branch opening. So first they have to survive in the particular level, or they have to find some other strategies. So to do this strategic planning and decide on the expansion, they should have the performance analysis. There's an efficiency ratio. In the banking sector, they are calculating efficiency ratio. Efficiency ratio will show this performance. So that is the first objective. Second one is to identify the areas and sectors to be improved. That is obviously you can understand. For example, when they are doing performance analysis, first what they will do is they will do the performance analysis overall. And they will do the performance analysis for a particular segment, sub-segments of the banks. Maybe branch operation, treasury operations. Likewise, they will do the subsections of the bank and finance companies. So under those circumstances, what they will do is they will identify whether this area need to be improved or not. And they will identify, okay, the treasury is performing well, but the branch operations are not performing well. Or sometimes the branch operations of the UA province or Eastern province or some provinces area are not performed well. So they can identify the area sectors to be improved. That is other objective of the performance analysis. And the third one is to identify different type of unidentified risk and to take mitigation action. They have to do the performance analysis. The performance analysis of the banks and finance companies will show what are the type of risk are emanating. For example, for the market interest rate or credit interest rate, for example, we can take the Nbl ratio, one of the performance analysis, which we will discuss. We are going to discuss. So under the Npl ratio, when in Npl ratio are continuously increased, then they can just decide, okay, there's a high credit risk, so it has to be mitigated. So they can find the way. Okay. Then other one is compare with the industry sector and peers. That is most important for one of the objectives of the finance analysis. For example, in the banking industry, the industry average ROA, return on assets or return on equities, are industry average, but the particular bank ROA and ROE far below the industry average or far below the competitor or peers. Then they can decide, or they can decide on what they have to do. So compare with the industry and sector peers, there should be a performance analysis. That is one of the objectives. Another one is to decide on capital planning. That is, I have already explained to you all. The capital planning should be based on the future expansion of the business. So if they wanted to expand the business, for example, they wanted to expand the business, or in the investment of treasury bill and treasury bonds, then capital infusion is not that much important, because the treasury bill and treasury bonds are comparably less risky assets. So the capital adequacy ratio will not require more capital. But if they expand the business to microfinance business, or some loans and advances business, then it may require more risk-weighted capital. So to decide the capital planning and all, they have to have the performance analysis, as well as what are the sectors they are going to expand it on. And to assess the level of profitability and quality of the earnings, then again they have to, that is one of the objectives of the performance analysis. And to address the low yielding assets, to measure the level of efficiency, to address the inefficient operations. But performance analysis is one of the objectives. That is also objective, because inefficient, of course, I have explained to you. Some provinces expenses are high, operating expenses. Some are very cheap, so they can compare the inefficiency of the operations. Sometimes within the province, some banks are having the high operating expenses, some branches are not having. To identify those things, to assess the level of meeting there should be a space, the day-to-day liquidity requirement, then performance analysis is required. So before going to the ratios, do you all have any questions on this? Okay, since you all don't have the questions, I'll move into the some ratios, which are sort of important ratios, so you can just get an idea about this ratio. The first one is gross NPL ratio. The NPL ratio, if you all work in the banks and finance companies or leasing companies, you all may know more than me about the NPL ratio. What is the meaning of NPL ratio? Non-performing loan ratio. When a bank grants the loans to the customer, and customer has to repay a monthly installment, EMI, equally monthly installment, and if the particular customer failed to make that 3 installment, then that particular loan will transfer to non-performing loan, sort of bad loans. Understand? So those non-performing loans, so they have to calculate a ratio. What is the total non-performing loan out of the total loans? What is the portion of the NPL ratio, NPL out of the total loans? So which will show the asset quality of the bank. For example, they are having 100 million portfolio. 100 million portfolio. Simply, we will take that simple example. 100 million portfolio. Out of the 100 million portfolio, the 10 million of the loans and advances are not performing, or they are the person who obtained the 10 million worth of loans and advances are not paying to the bank. So the particular loan has been transferred to the non-performing loan category. Okay. Now, what is the cross non-performing loans for the particular bank? Bank X, we will take as a bank X. What is the cross NPL of the bank X? Which is 10 million. Okay. Then divide by, what is the gross loans and advances I have said to you all? The 100 million. So 10 million divided by 100 million multiplied by 100 is 10% is the gross NBL ratio. Do you all clearly understand it? Is it okay? Or any doubt? Do you know how to calculate the NPL ratio? You have to take the NPL, non-performing loans, divide by the gross loans and advances, multiply by the 100. This is the simple way. This calculation can be do for a total loans, and product wise also we can do, branch wise also we can do. The particular branch also we can take. Okay, for example, some branch, Candy branch. Okay, the Candy branch, what is the total NPL in that particular branch, and what is the total loans and advances of the particular loan, divided and multiply by the 100. It may be 8% or 9% or 10% or 5% and all. That is called gross NBL ratio. Okay. Then the next, when you are seeing the next one, that's I am saying that net NBL ratio. What is the difference between the gross NBL ratio and net NBL ratio? What is the difference? Can anybody? Yeah, actually there's the same questions asked from me, from one of the students. Sir, what is the difference between the gross NPL and net NPL ratio? Okay, that's what I am going to explain to you all. Okay, we will take the same example. A bank X, which is having 100 million loans and advances. And out of 100 million loans and advances, 10 million worth of loans and advances have been defaulted. The one customer, he got the 10 million loans and advances, he failed to pay, so we transferred that loans 10 million as a NPL. For up to this point, you are clear now? Okay. Now we have categorized those loans into the bad loans. Okay. Now the next thing is the bank will start for a recovery process. Okay. If the customer failed to pay, bank won't just give up that. What bank will do is, bank will try to recover those loans. So, for example, they have for a 10 million loan, they have mortgage some 2 million worth of lands, land and building for the as a security for this particular loan, 10 million loan. Okay, for this particular 10 million loan, they have mortgage 2 million worth of land and building as a security. So in any worst case, they can sell this land and building, particular customers' land and building, and they can recover the 2 million rupees. Understand? Okay. Now the gross loss may be 8 million rupees because the total loans and advance, the NBL loan is 10 million, out of which 2 million they can make as they can sell, or they can recover from the land and building mortgage against that particular loans. So net exposure is only 8 million. Okay. For this 8 million, they may make the provision. Okay, they have to make the provision, 8 million rupees provision, because the bank will know, okay, if any worst case scenario, I may lose the 8 million as a loss. So they will make the provision, sort of they will allocate some profit against this bad loans, though they have to make the 8 million provision. So now we can just reiterate the numbers. The 10 million is total loans and advances, and NBL is 10 million, 100 million is total loans and advances, 10 million is the NBL ratio, and for against this 10 million loan, the bank had made 8 million as a provision, loan loss provision. Now we can calculate the net NPL. So the net NPL ratio is gross NPL minus provision. So what is the gross NPL? 10 million. What is the provision, loan loss provision for this particular loans? 8 million. So the net NPL is 2 million. So now the net NPL ratio is 2 million divided by net NPL divided by the total advances 100 million multiplied by 100, 2%. Have you all got it? If you all don't understand, please let me know. I'll just again explain. I think I'll very slowly explain to you all. Have you all got it or not? The difference between the gross NPL and net NPL is the loan loss provision. The gross NPL is the total non-performing loan without considering provision or anything. But the net NPL means gross NPL minus any potential, any specific loan loss provisions. Okay. So here in the example, the gross NPL is 10 million and the bank made 8 million as a loan loss provision. So net NPL is just 2 million rupees. So net NPL has to divide by the total loans and advances, multiply by the 100. So 2% will be the net NPL ratio. Have you got it or not? Okay. There's one of the students asked that please explain again. Okay. I just because it is something, it is worth for you all at the, or even at the office also. I'll just go to the again the gross NPL and net NPL differences. The gross NPL means, for example, if a particular bank having the 100 million worth of, I'll take some different example. If a particular bank has a 200 million worth of total loans and advances. Out of these 250 million loans, some 50 million worth of customers, they default the loans. It means the 50 million worth of customers, they fail to make the payments, their monthly installments. Okay. Then in this particular scenario, what is the gross loans and advances? The total loans and advances, gross advances, it is 250 million. Understand? What is the gross NPL, total NPL, which is 50 million? That is the amount the particular customer failed to, or particular customer or customers failed to make the payment. So the total non-performing loan is 50 million. So if the gross NPL ratio is simply, we can calculate gross NPL divided by total loans and advances, multiply by 100. So what is the gross NPL? The 50 million. What is the gross total loans and advances? 250 million. Then if we multiply by 100, the gross NPL ratio is 20%. Understand? That is clear. Now, there is other ratio called net NPL ratio. The net NPL, what is the difference between the gross NPL and net NPL in the sense? The gross NPL is a sense 50 million worth of loans have been defaulted by the customers. In that scenario, sometimes banks having considered any securities, maybe vehicles or land and building or something, at the time of obtaining the loans, these customers would have given to the bank as a securities. So by considering that security value, they may make some provision, loan loss provision against these non-performing loans. Understand? So when they are making the provision, then we have to deduct that provision value from the gross NPL ratio. Okay? In this example, 50 million is the gross NPL ratio. Let's assume the bank made some 10 million as a 10 million as a provision. Loan loss provision is 10 million. Okay. Now, what is the gross? So, what is the ratio for the net NPL ratio? Net NPL means gross NPL minus loan loss provision. What is the gross NPL I have mentioned here? 50 million rupees. What is the provisions the bank made? Which is 10 million rupees. So 50 million minus 10 million, which is 40 million, will be net NPL ratio. Understand? Okay. Now simply the net NPL equal to gross NPL minus loan loss provision. That is a simple understanding. So 40 million will be the net NPL. So net NPL ratio, how we are calculating? Net NPL divided by the loans and advances. So the net NPL is 40. Net NPL is 40 divided by total loans and advances to 250 multiplied by 100. 40 divided by 250 multiplied by 100. So NPL ratio will be 16%. Understand? So simply the gross NPL ratio is gross NPL divided by the total loans and advances multiplied by the 100. Net NPL ratio is the net NPL divided by the loans and advances multiplied by the 100. For the net, to arrive the net NPL ratio, what you have to do is gross NPL minus loan loss provision. That will give the net NPL ratio. This is the formula. Did you get it? Oh, still is okay. Okay, thank you. They say that they got it. So that is the difference between this gross NPL ratio and net NPL ratio. Here, of course, there is another interesting suspense and all, but I don't say here. That may complicate you. Actually, give me a second. Give me a second. Sorry for the disturbance. Actually, there was a sort of urgent call. So that is the gross NPL ratio and net NPL ratio. Other one is provision coverage ratio. The provision coverage ratio in the sense, how much of provision we are having for a gross NPL ratio. So here in this our early example, we are having 10 million worth of the second example. We are having for against the 50 million NPL, we made the 10 million provision. That is the assumption we got it. So the 10 million, the provision divide by the gross NPL ratio. So what is the gross NPL? What is the gross NPL we are having? 50 million multiply by the 100. So 10 divide by the 50 multiply by the 100. 10 divided by the 50. So 20% provision coverage ratio will be 20%. Understand? The provision coverage ratio is very simple. So what is the provision you are having against the NPL ratio? So if for a 50 million loans, you will make the 10 million provisioning. So you have to, what you have to do is provision 10 million provision divided by the NPL, gross NPA. NPA means sorry, here we can say NPL, non-performing loans, or NPA means non-performing advances. You can use the non-performing, the both words you can use, NPA or NPL. If you want, you can change it as NPL. So gross NPL, specific provision divided by the gross NPL multiply by the 100. That is called provision coverage ratio. Did you get it? Okay. Then other one is impaired asset ratio. Impaired asset ratio is under this SLFRS 9, IFRS 9. They have to calculate impaired asset ratio. Impaired asset ratio in the sense, sometimes the bank, the asset and some investments are impaired by this based on the fair value. So under that circumstances, impaired assets divided by the total assets multiplied by the 100. For example, if the particular investment value is 75 million, based on the impairment, the assets may reduce by the 5 million rupees. So 5 million divided by the total assets, the 75 million multiplied by the 100. That is the impaired loans asset ratio. And concentration ratio, which we have already explained to you. I think in the risk management section, we have already discussed these things. Concentration ratio, the bank, the entire portfolio of the bank may granted to several segments, several sectors. For example, they can give some percentage of loans to agriculture, some percentage of loans to tourism industry customers, some loans advances to who is that the consumption purpose, pawning and personal loans. Likewise, consumption purpose they can give, and some loans may be given to the manufacturing loans and advances, manufacturing customers. So based on this several segment or sector, the bank or one bank may grant the loans to several sector customers: tourism, agriculture, manufacturing, personal loans, and trade related things. Likewise, several sectors. Here the concentration risk what we are calculating is the loan granted to particular sector divided by the total loans multiplied by the 100. For example, if a particular bank which having 750 million worth of loan portfolio, out of the 750 million worth of loan portfolio, 75 million worth of loans and advances are granted to agriculture sector. Okay, then what is the concentration of the particular sector? Concentration 75 million divided by 750 million multiplied by the 100. So the concentration of the agriculture sector loans and advances is 10%. Because out of the 750 million loans, they have granted 75 million to the particular sector, agriculture sector. So the sector loans divided by the total loans and advances multiplied by the 100, which is called concentration risk. For example, here all these ratios are nearly related to asset quality, credit quality of the banks and finance companies, because NPL ratio will give the default risk. Default risk will give an idea about the default risk rate of the particular bank and finance company. NBL ratio, gross NPL and net NPL. Again, provision coverage also will give an idea about the how long the bank mitigate against the credit risk. And concentration risk also one of the part of the credit risk, which is also giving the concentration ratio. Have you all got this idea about these ratios? I wanted to discuss some more ratios. Before that, I just wanted to clear. If you all are clear about the asset quality ratio, then I can move to the profitability ratio. You will have any questions? Okay, I got it. Clear. Thank you. Those type of feedback will help me to move to the next slides. Okay, so far we have discussed about the ratios related to the credit risk or asset quality, which is NPL ratio and concentration ratio, Npl ratio. Now we are going to discuss about the profitability or earnings, because that is also one of the most important ratio, the performance analysis, the profitability and earnings. The profitability ratio, there are two main important ratios. In any performance analysis, there will be two main important ratios. One is ROA, other one is ROE. So what is the meaning of ROA? ROA means return on assets. Okay, ROE, return on equities. We will later on we will see the ROE. We will first check about the discuss about the ROA, return on assets. So how much of profit I earn by using this much of assets? That is the rationale behind this ratio. Because, for example, let's take the Bankers Loan. Bankers Loan is the largest bank in Sri Lanka, and it has a very long history. Okay, their profits may be high. Let's assume the Cargill's Bank, which is the youngest bank, youngest domestic, one of the youngest domestic bank in Sri Lanka, Cargill's Bank. Very recently they have opened, maybe less than 5 years period or 10 years period. And now only they are growing the bank. So asset base are totally different and their profits are totally different. So we can't just compare the Bankers Loan profit with the Cargill's Bank profit, because Bankers Loan is largest bank and their profit level may be high. The Cargill's Bank is small banks and they are now only they are growing. But this ROA will give an idea, sort of comparison between the Bankers Loan and Cargill's Bank, because based on the Bankers Loan assets, how much of profit they have earned, and here the other way around, based on the available assets, how much of profit has been earned by the Cargill's Bank. So we are comparing the assets based on the assets, how much they have profit earned, generate the profit. So this ROA will give sort of comparison between the largest bank and small bank. That is the whole purpose of calculating ROA. So based on the assets, which may be the largest or small. Based on that assets, how much of profit they have earned. So, which is calculated profit before and after. There are two ways. Generally they are calculating before tax, but there are way to after tax as well. Profit before tax divide by the total assets multiply by the 100. Because why they are taking the before tax is commonly because before attribute the tax, because tax is something we have to pay some statutory payment. Before that, how much of profit has been earned with respect to total assets before tax purpose. That is the ROA. ROA in the sense profit before tax divided by the total assets multiplied by the 100. Actually, there are other formula also. Profit before interest and EBIT. The profit before interest and tax divided by the total assets also they are calculating. But there are different formulas, but this is the generally you can use it. The profit before tax and divide by the total assets. And ROE, profit after tax, divide by the total equity. Okay, based on their equity level, how much of profit they have earned. Then profit after tax divide by the total equity. If we wanted to invest in the, okay, I'm just asking a question from you. You are an investor. You are going to invest in the particular bank or bank A or X. Okay, which ratio you will look into that? ROA or ROE? Particularly, okay, both are important ratios, but as a investor, which ratio you will see? You will look into the ROA or ROE. Or you are a shareholder of the particular bank. You will be interested on which ratio, ROA or ROE? Can you just tell me? Yes, exactly. That is the answer, ROE. Because as an investor, I will interested to what is the portion attributable to equity holders. Profit after tax divided by the total equity and multiplied by the 100. So as a shareholder, as an investor, I will have more interest on the ROE. So that is that is important for the shareholder. That is you have to keep in mind. And the other one also the sort of important ratios, not that much, but still in the banking business, finance institution business, they are calculating this ratio, efficiency ratio. Efficiency ratio are calculating operating cost divided by the total income multiplied by the 100. Total income means net interest income and non-interest income. Sorry, total income, no, we can't say total income. The net interest income plus non-interest income. So operating cost divided by the net interest income plus non-interest income multiplied by the 100. That is efficiency ratio. Other one is cost to income ratio. The cost to income ratio is calculated, cost to income ratio is calculated total cost to total income multiplied by 100. This is very simple, straightforward. The cost to income ratio is total cost of the finance institution divided by the total income multiplied by the 100. And staff cost to operating cost expenses, then staff cost divided by the operating cost multiplied by the 100. Actually, in Sri Lanka, some studies showing that in staff cost is more than 50% out of the operating cost. In the banking sector, remunerations are high, but in some other countries, staff cost to operating cost to income is not that much. Then the interest margin. Interest margin also one of the most important the profitability ratio, which is calculated net interest income divided by the total or average assets multiplied by the 100. In Sri Lanka, the net interest income, of course, you all know that how to calculate the net interest income. Total interest income minus total interest expenses. So you can get the net interest income. The net interest income divided by the total assets multiplied by the 100. In Sri Lanka, because that will give sort of efficiency of the interest rate efficiency of the particular bank and finance institution. Generally, as a regulators, we look into this interest margin of the interest margin of the bank and finance institutions. In Sri Lanka, the net interest margins is generally in the 3.5, 3.6 level. Earlier it was 4% level. Now then they have reduced to 3.5, 3.6 level. It is settled. The interest margin. When a bank has a high interest margin, they are operating in an efficient way. It means they are having high differences between the deposit interest and loans and advances interest. That will show that differences between the deposit rate and loans and advances rate. And the final ratio is interest income to total income ratio. Interest income to total income ratio. Interest income divided by the total income multiplied by the 100. This is also will give sort of a earlier those days in the conventional banking model will have more will have a ratio the very high level of ratio in this interest to total income ratio. But the modern banking business, they are depending on, or they are moving from interest income to non-interest income model, banking model. So now these interest income to total income ratios are gradually coming down throughout the year because the banks are mostly depend on the fee-based businesses rather than interest-based businesses. Okay, before going to the solvency, do you all have anything to ask from me? Okay, then having that, I'll just move into the ratio on solvency and capital. First, we have seen some ratio about the related to the credit risk, which is most important in a banking business. And second, we have seen some ratios about the profitability, which is also considered as a one of the important. And now we are seeing about the capital ratio. The capital ratio, of course, whether which give an idea whether the bank has adequate capital to absorb their risk level. So the capital ratio, the solvency ratio give an idea that whether particular bank and financial institution are having adequate capital to mitigate their risk or to absorb any unexpected risk. The first one is capital adequacy ratio tier 1 and total. What is the difference? Actually, under the Basel, this is one of the very vast subject. We can discuss a day fully, but I'm just simply saying that based on the capital, the Basel 3, the capital can be divided into two. One is tier 1 capital, other one is tier 2 capital. and joined together will be the total capital. Tier 1 plus tier 2 will be the total capital. So you can ask that what is the difference between the tier 1 capital and tier 2 capital? The tier 1 capital, they have defined certain capital item as a tier 1 capital, which is sort of high quality capital. Okay. Then other one is total capital ratio. Other one is tier 2 capital. This tier 2 capital is sort of hybrid capital. The hybrid capital means some debt component of the capital also will be included in the tier 2 capital. For example, subordinated debentures, 5 years more than, not less than 5 years subordinated debenture can be considered as a tier 2 capital. Okay, in the tier 1 capital, generally stated capital, paid up capital and paid up capital as well as return earnings. Likewise, high quality capital is included in the tier 1 capital. Okay, so tier 1 capital adequacy ratio are calculated based on the capital divided by the risk weighted assets multiplied by the 100. Do you all have any questions here? Here I have used a word risk-weighted assets. I am not sure whether we have discussed in this risk-weighted assets in the risk management section or not. Or do you all have any idea the risk-weighted assets, or do you all want me to explain? Okay, please explain. Okay, there are some students asking, please explain. I am saying you all that the tier 1 capital is a purely high quality capital. That's okay. Tier 1 capital. Here I have used other word, risk weighted assets. What is risk weighted assets? For example, a bank will take a two example. The one is the bank X. The bank X having the business model which use their money only to invest in treasury bill and treasury bonds and giving the loans and advances only to AAA companies in the market. Okay. Some other bank Y, the second example, the bank Y, they having the business model granting the loans and advances to agriculture sector, microfinance loans and advances, and SME sector loans and advances. Okay, there are two business models. The first business model, the bank X, which grant only loans to the only investment in the treasury bill and treasury bonds, and they are granting only to AAA customers, maybe JKH or something like a Dialog or something, the highly rated customers. Other bank Y, the second bank Y, which extended only to agriculture sector, SME sector, and microfinance loans and advances. Okay, now tell me which bank will have more risk? Which bank will have more risk? Bank X or bank Y? Which bank? I expect the answer from you. Whether the bank X, which give which only invest in the treasury bill and treasury bonds and give the loans and advances to AAA company. The bank Y, which have only which has loans and advances to SME and agriculture sector and microfinance loan. Which bank will have more? Okay, their asset size is same, loans and advances size is same. Both are having 100 million, 100 million. Okay. Under which circumstances, which bank will have more risk? Bank Y, of course. Bank Y will have more risk because they are extending to that the risky customers, SME customers, agriculture customers, and these microfinance loans. But the bank X will not have the high risk because the bank X will have this investment in the treasury bill and treasury bond. Of course, there is no default risk, zero risk or close to zero risk. And the AAA companies, the risk may be very low. So based on that, it is the Basel Accord saying that it is not reasonable to ask both banks to maintain same level of customer, the same level of capital. Okay, it is not reasonable to ask the bank X also having the 10 million capital and bank Y also having the 10 million capital, because bank X has the less risk. They are dealing with a less risk assets, but bank Y dealing with a high risk assets. So they are conceptually, they are saying that bank Y should have more capital. So with that idea, what they are saying is, okay, they are risk weighting the assets. For example, let's assume the bank is, we are having the 100 million loans and advances, but they are saying since it's a treasury bill and treasury bonds, just risk weighted only 20%, because there won't be much risk. And if it is a AAA companies, just weighted 50% only. So even though they have the 100 million worth of assets, when they are multiplied by the risk weights, 20% risk weight, their risk weighted assets will be only 20 million. The 100 million multiplied by the 20%, the 20 million will be the risk weighted assets. Risk weighted assets. But in the bank Y, they are having highly risky customers, the SMEs, microfinance loans. They say that the risk weight will be 100%, because you may lose the entire money. So in that case, they are risk weighting by the 100%. So 100 million loans and advances multiplied by the 100%, so 100 million loans. So their risk weighted assets will be 100 million. But the bank X risk weighted assets, of course, only 20 million. Let's assume both banks are having the 10 million as a capital. What will happen? For a bank X, the 10 million tier 1 capital divided by the risk weight assets of 20 million. So their capital adequacy ratio will be 50%. But in the bank B, their risk weight, the tier 1 capital is okay. They also 10 million they are having, but their risk weighted assets will be 100 million, because they are risky. They are dealing with the high risk assets, customers. So 100 million. So 10 million divided by the 100 million. So their capital ratio is just 10%. Even though both banks are having the same level of capital, 10 million level of capital, and same level of loans and advances, but the risk weighted asset, the capital adequacy ratio, the bank AX having the high capital adequacy ratio, because they are having low risk weighted assets. But bank Y will have the only very low capital adequacy ratio, because they are having high risk weighted assets. Understand? So the simple idea is the risk weighted assets mean your assets are weighted with a certain risk level. The risk is given, the risk weight is given by the Basel Committee. Generally, it is given by the Central Bank of Sri Lanka. It's given. So your assets weighted by the risk and getting the risk weighted assets. The bank X risk weighted asset is low because they are dealing with the low risky assets. But banks Y risk weighted asset is high because they are dealing with the highly risky customers or assets. Understand? So the simple as explanation for risk weighted asset is risk weighted by the risk, the assets weighted by the risk component and getting the risk weighted assets. Have you all got it? I hope you all have understand. Yes, clear. Okay. So the tier 1 capital adequacy ratio is tier 1 capital divided by the risk weighted assets multiplied by the 100. The capital adequacy ratio, total capital adequacy ratio mean I say that tier 1, there are two components of the capital, tier 1 capital and tier 2 capital, and both total. So tier 1 plus tier 2 taking the total. So total capital divided by the risk weighted assets. RWA is risk weighted assets multiplied by the 100. And net NBL to capital ratio, this is also one of the ratio. We have already, we know how to calculate the net NBL. So net NBL divided by the total capital multiplied by the 100 is a net NBL ratio. Net NBL to capital ratio. Because this ratio is showing that how much the bank is strong enough to absorb the risk arise from the credit, or simply arise from the non-performing loans. And the leverage ratio, this is a sort of new ratio calculated under the Basel document. So what they are doing is tier 1 capital divided by the total exposure without having the risk weights of the assets and all. They are just taking the total exposure and multiply by the 100. So these are the 4 ratios related to the solvency, but out of these 4 ratios, we are calculating first 2 ratios as the important ratios. You have to keep in mind the capital adequacy ratio, which give an idea based on their capital level based on or compared to the risk weight of their or risk level of their assets. Understand? Okay. Anything you all wanted to ask, or shall I move to other one? Because time is moving. Okay. Then there is other ratio called liquidity ratio. The liquidity ratio, of course, we have already discussed in the risk management section, but anyhow, I just say that the statutory liquid asset ratio. The central bank asks the banks to maintain the statutory liquid asset ratio, the minimum level of statutory liquid asset ratio. I think I have already explained to you. I am going to ask a simple question from you. What is the minimum statutory liquid asset ratio requirement in Sri Lanka? I have already discussed with you, or I have already mentioned to you, and in the risk management. What is the minimum statutory liquid asset ratio? 20%. Yes, it's 20%. So that ratio is calculated based on, actually the calculation is very complicated, but you can simply having the ratio, the final ratio is statutory liquid assets divided by the deposits or liabilities. If it is a licensed commercial bank, it should be liabilities. If it is a licensed specialized bank, it should be deposits. If you want, you can note it out. If it is a licensed commercial bank, you have to, the ratio is statutory liquid asset ratio divided by the liabilities, multiplied by 100. If it is a licensed specialized bank, the liquid asset ratio is statutory liquid assets divided by the total deposits, not liabilities, deposits, multiplied by the 100. and minimum ratio is 20%. Somebody may ask, what is the statutory liquid asset ratio? Actually, some assets are classified as a statutory liquid asset ratio based on the number 30 of 1988 Banking Act. The central bank can define these assets can be considered as a liquid assets. Generally, the treasury bill, treasury bonds, and SLDB, cash in hand, placement with other banks. Likewise, there are certain SLDB means Sri Lanka development bonds. So certain assets can be considered as a liquid assets, which is defined by the Central Bank of Sri Lanka based on the authorities given under the Banking Act. So if somebody asks what is liquid asset ratio, you have to say based on this Banking Act, the central bank gave, and central bank defined. These are examples are treasury bills, treasury bonds, SLDB, Sri Lankan development bonds, cash in hand, the placement with other banks. Placement means the banks going the deposit with other banks. Understand? Then other one is liquid assets to total asset ratio. The liquid asset to total asset ratio, of course, again you have to take the total liquid assets, divide by the total assets and multiply by the 100. Actually, first ratio is very important. Other ratios also we are using not that much. And other one is current ratio, which is everybody may familiar with this. In A level you would have studied about this. Current ratio means current assets divided by the current liabilities multiplied by the 100. And the leverage ratio, it is not leverage ratio, liquidity coverage ratio, which is also sort of new ratio. This is implemented based on the Basel III document. What they are doing is high quality assets. They here again they define what are the liquid assets are high quality liquid assets. The high quality liquid assets are divided by the net liquid asset outflow for next 30 days and multiply by the 100. So which is liquidity coverage ratio. And net stable funding ratio, of course, the available amount of stable funding divided by the required amount of stable funding and 100. Actually, these are some new ratios introduced under the Basel III documents, and this is sort of the net stable funding ratio, sort of long-term ratio, and liquidity coverage ratio, sort of short-term ratio, because this is covering only for 30 days, but this is the funding requirement for long-term. This is long-term, and the calculation are some complicated, but you can just keep in mind the liquidity coverage and net stable funding ratios introduced by the Basel III document, the Basel III requirement, under which the liquidity coverage ratio is sort of short-term indicator. Net stable funding ratio is sort of long-term indicator. But out of this liquidity ratio, the first one is most important. Before moving to the other one, I just wanted to ask from you. No, I just wanted to tell you something. When we are going for an examination to the banks, we are doing a supervisory check or performance analysis based on the risk analysis based on the CAMEL ratio. We are saying the CAMEL, C-A-M-E-L, CAMEL. It's called CAMEL analysis. The what is CAMEL analysis is C for credit quality. Sorry, C for capital. A for asset quality. Asset quality in the sense the credit. Asset quality. CA. M for management. E for earnings. L for liquidity. Of course, management it's sort of a qualitative one. Other four things we are having the quantitative ratio, which we have studied so far. Asset quality, profitability or earnings, and capital as well as liquidity. So when we are going the examination, we are checking these are primarily we are checking camel analysis, management, of course, we are checking something related to corporate governance. That is sort of qualitative one. For the other four components, capital, asset quality, liquidity, and the earnings are based on these ratios, quantitative analysis. These are the ratios generally carry out, calculated by the central bank. And on top of that, this is other investor ratio. The investor ratio, there is a net assets per share ratio, which is normally in the stock market. If you are familiar with the stock market transaction, you all may heard about it. Net assets per share ratio. So every share, what is the assets component attributable to the each and every shares? That is generally net assets divided by the total number of shares. And earning per share, profit after tax divided by the number of shares. These are very straightforward calculation. And dividend cover ratio, profit after tax divided by the dividend per share. And dividend payout ratio, dividend paid divided by the profit after tax multiplied by the 100. These are some investor ratio. If you are involved with the stock market analysis, you will be interested on these ratios. So these ratios also will show, will facilitate to the stakeholders, or especially the investors and shareholders, for their earnings, to ensure their earnings. I think other area we can just move into the these all about the ratios. You will have any questions on this? Okay. Then I'll just move into the this. Okay, this is we have already discussed. I think the prudential ratios, that is accounting based ratios, and prudential ratios, again ratios that are used finance institution regulatory authorities to monitor and to determine the stability of individual financial institution and financial system stability as a whole. This is what I have already mentioned you all. When we are going the examination purpose to ensure the stability of the individual financial institution, we calculate these type of ratios: the capital, camel, that is capital, liquidity, asset quality, and risk management. Of course, management, this is they have just said. So these type of ratios, and earning as well we are checking. And capital adequacy ratio, of course, we have already discussed, and these ratios we have already discussed. That's what I need not, I think, again explain to you all these ratios. And points for risk focus business performance report. The variance analysis with short-term target, budget, strategic plan, and KPIs and benchmarks are analyzed for the risk focused business performance, and identify the trends compared with the previous period. These are also one of the indicator for the compare with the previous periods trends, which will help for the risk focused business performance reports, and compare with the peers, statutory, industry and sectors, check compliance with the statutory and legal requirement, assess for new business opportunities and all. These are the things facilitate for risk focused business performance report to prepare. And finally, we are going to discuss about the limitation in ratio analysis. Actually, even though we are using the ratio analysis as one of the performance analysis purpose, there are some limitations. What are those limitations? First one is, it is the historical ratios. It will give only the past information. It will not give the future information for the analysis. Okay. information used in ratios analyzing driven from the actual historical results. But most of the investors and regulators expected to see some early warning indicators. But this ratio analysis is only historical data. And other one is inflation. As inflation may get changed, but there won't be any comparison between the factoring the inflation. For example, the last year's 100 rupees, this year's 100 rupees different because of the inflation. For example, by using the last year, if you had the 100 rupee, you would have buy some item, but based on that particular 100 rupee, you can't buy the same item this year because due to the inflation, the prices may increase. But the ratio analysis will not factor or will not show that inflation difference in the analysis. They will just say that okay, last year also 100 rupees, this year also 100 rupee profit, so it is maintained. But actually, it is not maintained that value. So inflation is a factor which will not be captured in the ratio analysis. And company may change its underlying operational structure compared to the same ratio today would yield the misleading. Company may change the business model and not, but that may not capture through this ratio analysis. And accounting policies, there may be changes, but that may not be sufficiently captured in this ratio analysis. And company strategies, again, it may appropriate to conduct ratio analysis comparison between two firms that are pushing the different strategies. So maybe the bank, we can say the same example, Bankers Loan may have different strategy and Kagals Bank may have different strategy. But even though both are in the banking business, for example, Citibanks, even the Sri Lankan Citibank Sri Lanka may have different strategy. They may not function as a people's bank. So, but ratio analysis does not factor those things. That is one of the limitations. And point in time, it give on a particular point in time analysis and all. So these are some of the limitation in the ratio analysis which we can say. And finally, this is all about the ratio analysis and the accounting things. So I have just listed out some sample questions. You can go through it, and if you want any answers, you can ask from me the next class. Due to the time constraint, I may not explain these questions today. You can go through these sample questions, and if you have any questions, you can ask. Or you all want me to discuss this in the next class, or only you can ask anything you'll doubt. If you have any doubt, you can ask. There are two ways. One is you can go through these questions and you can try to answer it. If you have any doubt, you can come and ask from me. Or otherwise, we can I can explain you one by one. I don't know which way you prefer. But okay, you can just come the next class. You can tell me which way you want. If you want, I can just go through one by one these sample questions and explain to you all. Otherwise, if you can answer these questions, if you have one or two doubt here and there, I can clarify those things. We both ways okay for me. Just let me know which is the convenient to you all. That's all about today's class. Do you have any questions from me? Okay, if you all don't have any questions, I will just stop this class with this. Just go through these questions. If you all don't have any doubts, that's fine. Or if you all have any doubt, I can just clarify those doubts in the next class. And most probably we can start some more new topic in the next class. Thank you so much.